Today I'm delighted to introduce Scott Freidheim to you, who is the CEO Europe of Investcorp. And so I would like to talk about a topic that was touched upon at his speech at our symposium today. Scott, thank you for coming today. And so I wanted to ask you to introduce a little bit more the PE model, especially in your company, and also what your thoughts are of the PE model of the future.
So Investcorp was founded 30 years ago. And the firm was founded on the premise that there was a surplus of cash that was being accumulated in the Gulf due to the rise of the price of oil. And that investors across the Gulf had options from the large financial institutions, namely to invest in stocks or bonds. Our founder, Namir Kirdar, founded the firm on the premise that we would serve as the bridge of opportunity in alternative assets from North America and from Europe to those investors in the Gulf. We were the first firm to do so. And as it relates to the business model, interestingly, what Namir did was he created an ownership group that was not held by one individual or one country, which was the standard in the Gulf. Rather, capping each investor at 0.5% of ownership, and secured the most prominent businessmen across the Gulf, all 6 GCC countries, to be 50% of the ownership group day one. That ownership group remains largely the same today, a subset, the board of directors, and on day one that served as the placement capability. So in our business model, what we do is we'll buy a company in Europe or in North America, and we will own it entirely with funding from ourselves and from banks. We then go to our investors, who are ultra high net worth investors in the Gulf, and say, would you like to participate? So the business model for 3 decades has been and continues to be deal by deal, and it affords our investors the opportunity, 2 key things: discretion, do I want to participate in this asset, yes or no? And weighting, to what degree do I have conviction and to what degree do I want to invest in this specific company? That has stood the test of time, and we're thrilled that over the past 3 decades we've been profitable every year, and our shareholders have had a 17% per annum return. So Investcorp is founded on the premise that there is a client need, and we are going to fulfill that client need and focus on delivering long-term results cross-cycle. To your question about business models, and is the current standard in the industry, the fund structure, a viable structure that's fit for the future? I think that there are lots of pressures today on private equity firms with fund structures, and you see it on the demand side meaning private equity demand for assets on the demand side, while we have 90% of all-time high levels of uncommitted capital or dry powder. Most of that was fundraised in 2007 and 2008. And it's been difficult to deploy that capital because of the lack of clarity in the political and economic environment and the lack of leverage born out of the financial crisis. So they're on the road today, and they're trying to fundraise, and there are a record number that are on the road today, 1,950 trying to raise $800 billion. But it's difficult to see that they're going to be able to replenish those coffers at the prior level. And on the supply side, the industry has deployed $1 trillion in the 5 years leading up to the financial crisis, and deal volumes have dropped to a quarter of the pre-crisis levels. Therefore, it's been difficult to exit investments. The IPO markets have been difficult on a relative basis. Private equity has had a hard time deploying capital because of the reasons we just talked about. And the corporate buyer has been focused on strengthening their balance sheet in a post-crisis environment. So that has led to 10 consecutive years of increase in the number of companies that are held in private equity hands. As a result, for those private equity firms who can weather this current storm, the pressures on both demand and supply are going to both push for lower pricing for assets, so it will be an attractive environment. What will make companies weather the storm? Innovation. And private equity today is in a position of an imperative on innovation. And we should see it come in many forms: running smaller firms, collaborating with other private equity firms or with other of its strongest limited partner relationships, whether that be pension funds, endowments. We should also see it in terms of product category extension, whether that be in the credit space or into even hedge funds. We should see it in the way that they target new investors, whether that's through the creation of mutual funds to tap into retail, private channels with private banks, or in new geographic markets, notably Asia. You should see it in terms of acquisitions to look to smooth the revenue streams. And you should see some institutions, some firms capitulate to the difficulty of the environment and become divestiture funds that focus simply on the maximizing of the value of the current portfolio. But from all of those dynamics on supply and demand, you will have a series of strategic opportunities that are pursued, and private equity will innovate, and you will see a continuing amount of strategic divergence and business model proliferation. But for those firms that focus on solving a client need or solving one of their problems, who are committed to achieving attractive risk-adjusted long-term returns and who leverage their strengths, those are the ones that are going to succeed. And I think there's a ton of talent in private equity, so expect a lot of innovation.
Thank you very much, Scott.